Hey everybody, thanks for joining us on our webinar that we're going to have regarding Spartan Storage Fund 1's waterfall structure. And just before we get started, we're going to get our disclaimers out of the way. We're not offering any legal advice on this webinar. Please do all of your own due diligence on the offering documents. Consult your legal and tax team on any tax or legal issues, and we are not providing that legal or tax advice. We're not CPAs. So please do your own due diligence. And this is just a general overview to help educate you on the waterfall structure for the fund. But before we get started, we want to just talk about what the targeted returns are for the fund. Our targeted return is 15 to 20% cash on cash or annual return for the life of the hold period. And this produces about 5 to 8% per annum cash flow throughout the course of the investment. This is distributed monthly and projects 5 to 8% with about 5% distributions projected in the first year, and it grows thereafter as we roll out our business plans and increased revenue in the portfolio. And this all wraps up to about a 13 to 18% levered IRR, and that levered IRR just means that we take debt on these assets 60 to 65% of total project cost typically, and this delivers about a 1.7 to 2.2x multiplier by the end of the hold period, meaning that on average, the projected would be about doubling your money every 5 years. So if you put in $100,000, you would expect to get your $100,000 back and then make $100,000 on top of that, receiving a total of $200,000 back from a projected standpoint. So the return structure, all of this information, by the way, can be found in our private placement memorandum, or what we call the PPM. But we know that limited partners Class A shares, this is a minimum investment of $50,000, get a 7% preferred rate of return, a 70-30 split, up to a 14% cash on cash hurdle. And then there's a 50-50 split with the sponsor thereafter with Spartan Investment Group. On the Class B limited partner side, with minimum investment of $1 million, the preferred return is increased to 8%, still that 70-30 split, but to a 16% hurdle as opposed to the 14% hurdle, and then a 50-50 split. And what we're going to do on this webinar is we're going to dive into exactly what this means and how you would track this from a preferred return, split, disposition, and operating returns standpoint. So here's what we're talking about today. We're really talking about the plan of distribution. So this is section 10 of the PPM, and really page 32 and 33 really address how capital is distributed after there's profit from operations and after there's profit from what we call a liquidity event from a sale or refinance. And these sections here that are circled are really what we're talking about. This covers where money is sent when we have distributable cash from operations. And this section talks about what we do in the event of properties being refinanced or sold throughout the course of the fund investment. And these definitions are really critical over here on page 33, especially cash on cash return hurdle, net capital contributions, preferred return, etc., as they define how the waterfall is spoken about in the plan of distribution section on page 32. So let's first talk about what is a preferred rate of return. There's a lot of different types of preferred returns. So it's really important whenever you're evaluating an investment, you understand how your preferred rate of return is accumulated or not, or compounded or not, and what that means to you as an investor. So in this case, our preferred return, this is from our definition on page 33, means that a Class A and Class B unit holder, a sum equal to a percent per annum. And that, percent per annum is important because remember, Class A members get 7% and Class B members get an 8% per annum preferred rate of return. And the second part of the definition says that it's non-compounded times the amount of unreturned net capital contributions of such members calculated monthly. And what that means is that our preferred rate of return is rolling. So if we don't hit the preferred return of 8 or 7% respectively, that would accumulate to the following year, and you would have what's called a capital account or preferred return account balance. Now, non-compounded means that that balance doesn't earn any interest. It just rolls over from year to year to year. So if it did say compounded, not very many offerings say that, but that's what that would mean. So it's non-compounded, but it does accumulate every single day. And if it's not paid, you as an investor are accumulating a preferred return account balance. So let's really dive in though to the unreturned net capital contributions. That's a really important definition that we're going to talk about. And that's, for those following along in the PPM, can be found on page 33. So net capital contributions mean that the initial capital contributions of any additional capital contributions, if any, made by Class A or Class B, and remember, you can add incremental investments to the fund of $1,000 above the $50,000 minimum investment. So that's what the additional capital contributions means. As reduced by any distributions made by the company to such member from net distributable cash from operations or from refinance or dissolution. So I just want to highlight as reduced by the amount of any distributions made by the company. So your net capital contribution balance is being reduced when funds are given back via preferred return. There's a bit of a tax advantage here to doing that because it's considered a return of capital, and that allows us to avoid taxes during the hold period. But again, let's just from anything from operations or from refinance or dissolution is what the net capital contribution gets reduced by. So this, again, this definition, it can be found on page 33 of the PPM. So how does this really work? So what does this all mean? And what does it mean for my capital contribution? And how do I make income on this investment when you reduce a capital account based on money being sent back on a preferred rate of return? So let's just say in this example, an investor places $100,000 into the fund. So their beginning year, day one net capital contribution balance is $100,000. And so their preferred return is calculated by a simple 0.08% times 100,000. That gives them a preferred return accrual at the end of year one of $8,000. And so let's just say they're the only investor in the investment for this example. They put in 100,000. We gave them a Class B share. They're a Class B member, and they're the only investor. And the project distributes $5,000. Well, what you would have now is an unpreferred return balance of $3,000. So let's talk about, the waterfall. Basically, it says, first, from net distributable cash from operations, Class A and B unit holders get a preferred return in proportion to the respective preferred return balances until each unit member's preferred return balance is reduced to zero. So in this instance, we have to roll over and accumulate that preferred return balance until it's paid off. So these two numbers, though, are important because, remember, you start with $100,000, but remember, we talked about unreturned capital contribution balance. And so you have to take the $100,000 that you started with and subtract the distributions to come up with your year two beginning net capital contribution balance. Because we've given back $5,000 of preferred return, now the capital account balance starting in year two is $95,000. And if you wanted to calculate how much preferred return accrues from that number, you would have to multiply that number by 0.08%, and you can see that it reduces by $400 for the year. Now let's just say the project distributes $7,000. Well, you would still have to take the $7,600 minus the $7,000, and you would find that you have an unpaid preferred return accrual for the year two of $600. Now remember, you still have to add the $3,000 from the previous year to this $600 to calculate your preferred return balance. And what's great is we have a software program that calculates all this, and actually your preferred return account balance accrues daily. So every day that preferred return accrual updates in our system. And so now in year three, to start year three, you have to say, okay, well, what's my capital account balance? So you take the 95,000 and the 7,000, take 95,000, subtract 7, and that's what starts your year three net capital contribution balance. Again, your preferred return is calculated based on 8% of that. And if the project distributed, say, $8,000 this year, well, now you're going to have a negative number. That means you exceeded the preferred return payments for that year. However, remember, you've got that rolling rate, preferred rate of return from the last year. So you have to take the $3,600 and subtract that from the $960. And now your preferred return balance is $2,640. And so we're going to do the same thing. We're going to take 88,000 minus 8. You start with 80. Again, that year, your preferred return accrual to be about $6,400. $8,000 is distributed. You overpay the pref by $1,600. However, you've got that accrual, and you've got $1,000 remaining over. And then you take those two numbers. And again, you can see sort of the next year we have the same distributions, and you would have a now negative preferred return balance. And what's interesting, we're going to go into this more, is that $1,200 now goes to the second step in the hurdle, which is that 70-30 split. And we'd have to split those funds based on that 70-30 split. But one thing I wanted to talk about is just what your ending capital contribution, ending account balance would be, your net capital contribution balance would be. And you'd have to take the 72,000 minus the 8,000. And you can see, again, year 5, $1,200 is applied in the second hurdle. And we're going to go into this a little bit deeper. But essentially, the investor is going to get the $800 or so dollars. The sponsor gets $360. So your ending capital account balance for that year is for the hold is $64,360. And we're assuming that the investment ends at the end of year 5. And so that $1,200, $360 of it went to Spartan. The rest went to the investors, which is why you see that $64,360. Now, let's just talk about the second hurdle that we talked about a little bit previously. So the second hurdle is a 70-30 split between Class A and Class B unit holders in proportion to their respective percentage ownership interests, and 30% to Class C, which just means that 30% goes to Spartan. We're the Class C holder, in proportion to their respective percentage ownership interest until investors have achieved their respective cash-on-cash hurdle. Well, cash-on-cash hurdle has meaning. And for those that are wondering, how come my preferred return account balance is reduced? It's actually not for a cash-on-cash hurdle, and here's why, or here's where it's listed. So cash-on-cash hurdle is actually consistent with the original amount of capital that was invested at the onset. So specifically here, we talk about the 70-30 split, but the cash-on-cash return hurdle for unit holders is determined by the amount of capital contributed at the timing of the purchase of units. So that means that if you put in $100,000, your cash-on-cash return hurdle is based on $100,000 throughout the entire course of the investment. So when we talk about that, we need to understand, and for Class B, that's 16%. So when we look at this preferred return balance, we talked about everything above that line, but let's talk about what happens in that 70-30 and what we mean by the cash-on-cash hurdle not being reduced, the capital account balance not being reduced. So in your 16% hurdle, 70-30 split, when we get down here, that's $16,000. We have to take 16% of $100,000, and your in-year hurdle is $16,000 in addition to your preferred return account balance, which is 100% distributed to the investors, nothing to Spartan until that preferred return is hit. So let's just say we know that the distro for year 1, remember, it was $5,000. So really that 100% of that goes to the investors. The 70-30 split doesn't even kick in for that. We don't even receive anything for that because we didn't get above the $8,000 pref, and we, of course, didn't hit this 50-50 split either. So in year 2, same thing. We had $16,000 hurdle, but we didn't even hit it, right? So we only distributed $7,000. Again, none of the subsequent hurdles are even touched. Year 3, same thing. Year 4, same thing. And then year 5, remember we had that $1,200 that actually hit the second waterfall hurdle. So let's talk about that. So you have the $16,000 hurdle. $6,800 went 100% to the investor. That's the first hurdle. That was all preferred return. And then the second tier went to the investors. That $840 went to the investors. And then Spartan got a $360 split with the investor. So the investor has accumulated around $35,000 of cash flow so far, and Spartan has now just made the $360 from the split. And of course, in this example, there is nothing left over after that, so there is no 50-50 split. So let's talk about what happens when the project sells. Well, let's just say at the end of year 5, there's $180,000. There's only that $100,000 investor in this example, but there's $180,000 that there's in profit to distribute. So the investor is going to receive the following. So first of all, you want to make sure you understand where this is at in the PPM on page 32. And this is distributions waterfall that covers what happens when there's a liquidity event, such as a refinance or sale or et cetera. So let's go through it. So first of all, the investor is going to get first step in that waterfall is they get their preferred return account balance reduced to zero. And remember, we did that in year 5. We actually had a surplus of $1,200. So that is done. The second thing the investors get is they get their capital account balance gets reduced to zero. And remember that 64,360 number? That's what's owed to the investors to clear out the remaining capital account balance. So what we have to do is we have to take that $180,000 that we received. We have to subtract $64,360 from it. That's the investor's remaining capital account balance. And that gives us a remaining $115,640 to distribute. Okay, so what happens next? How do we divide up that remaining $115,640? Well, the next thing you have to do is you have to do a 70-30 split with the investors to the 16% cash-on-cash return hurdle. Okay, well, that's $80,000 that goes to the investor. So how do we get that? So, well, first of all, remember, it's based on your original investment at the purchase of the units. So you have to take 16%, which is that cash-on-cash hurdle, multiply that by $100,000 for 5 years. So that's $80,000 is the preferred, is the hurdle for the 70-30 split. Okay, so you're thinking, okay, so how much of that $115,640 should go to that 70-30 split? Well, you take $80,000 and you divide that by 0.7 or 70%, and that gives you $114,286 to distribute in that step of the waterfall. And it's simple. Spartan gets 30% and the investors get 70%. So the investors in this case are going to get, that one investor is going to get the $80,000, and this $34,286 goes to Spartan. And lastly, the 50-50 split, which happens. And there's a typo on the slide, but it actually is reached. So $115,000 was available. We sent out $114,286, and there's $1,354 remaining to split. And that's just simply cut in half, 50-50. So about $650 or so. So let's summarize this. All right, so the investor puts in $100,000, and over the course of 5 years, they make $180,677 back. So a net profit, $80,677, and 100% of their investment their original investment returned. And how did this happen? Well, first, the investor received $35,640 from operating distributions. This is that first liquidity, or the first distributions from operations waterfall that we went through, and the investor got $35,640 from cash flow. This is monthly distributions, and this was all under the first hurdle of the preferred return. Okay, the next step in the waterfall. When the investment sold, the investor made $64,360. That was a return of capital from their remaining net contribution balance, right? That was their outstanding capital account balance that was owed back to them after their preferred return was paid down, which we did, and this came back. The next thing is the investors received $80,000 from the 70-30 cash-on-cash hurdle split. And then lastly, there was a 50-50 split thereafter, and the investors made $677 from that. So when you add all those up, the investor invested $100,000 and received $180,677 back over the 5-year hold. And if you are quick math here, that's about a 1.81 X equity multiple, meaning that they just landed shy of doubling their money in 5 years. And that's about a 16.1 annual return through the hold period of the investment. So one question that we had about this was, does my ownership in the fund ever change for any reason? And the answer is no. Your ownership always stays fixed, and it does not change for any reason. You buy a share, it's a fixed percentage ownership, and that never changes for the purposes of depreciation or just ownership in the fund. And lastly, when does a distribution become taxable? And so our guidance from our CPA was that when the amount distributed exceeds your basis in the investment, so when it exceeds how much you've actually invested in a project, that's when it becomes taxable. So we hope you found this helpful. And like, if you have any questions on anything about the fund, you can always email us at investors@spartan-investors.com. Thank you so much for listening, and we look forward to working with you in the future. Thank you.